Hello and welcome. You are joining us live on the Investor Lab, albeit 4 minutes late to our regular start time, and albeit with slightly choppier internet than usual, because once again, we're in the lucky country, lucky for some, but not for those who want to use the internet. Australia.
Apparently not. I'm getting there's so much like background noise. Hang on one second. Keep yakking. Sorry. This is madness.
Look, I can yak on for a while. I can yak on for a while because we've got a lot to talk about today. We are evidently experiencing a few technical issues. We are on safari in the Great Southern Land in Australia.
On safari.
And yeah, we're on safari.
All our family and friends of the animals in the zoo, and good.
I mean, you can call your family animals if you want. That's fine. But yes, so we are here in Australia and we are out of our normal environ and navigating through a few technical issues. But thank you for joining us, Jared. Great to see you. If you are here live, let us know you are here live. And if you're not here live and you're watching this later, leave us a comment on YouTube. Let us know that you watched it later. Let us know what you think. Gabby,
hello,
how are
people.
you sitting out in the cold?
I'm freezing. What is this country? It's so cold. Otherwise, I'm okay. I'll just be like,
nice.
If I'm like this, I'm just struggling a little bit.
Yes. But the thing is, it could be really hot in a minute.
Don't get me started on the weather, Goose. Don't. I get really worked up about the inconsistent weather here.
Yes. Anyway.
Yes.
So we are here once again in Victoria.
Yo.
But we are here. So we are here. We are experiencing the splendor of all of the things that we've been talking about on the podcast over the last however long. Cost of living. Yes, we have paid $3.20 for diesel in a car. Yes, we have paid $400 for some basic groceries. Yeah, yes, we are now immersing ourselves just to make sure that we've got the flavor to savor on this economic expedition.
Wow.
But there's a lot to cover off today. I feel like, Gabby, that primarily our job every 2 weeks is to identify the latest boogeyman that's been thrown out there by the media and to debunk the boogeyman.
Pretty much.
So
yep. Like we've said before, it's pretty much keep calm and carry on is in 10 different ways.
Yeah, exactly. And that doesn't always, by the way, mean that nothing is going to change. In fact, invariably, everything's always going to keep changing. So it's not a case of like nothing to see. Sometimes there is something to see, but also it doesn't mean that it's a problem. And we're going to be talking about the CGT. What do they call it? A CGT discount reform. Okay, CGT discount reform. We're going to be talking about the CGT discount reform today, whilst Gabby keeps herself warm with that mug there in front of it.
Unfortunately, I have to use my hands during this podcast. Otherwise, I'd be sitting here like this. But yes.
Nice. Erica said that she's considering Uruguay. I think Uruguay would fit the bill of the level of tropicality that we need. So super up for that, Erica. Good to see you here, Richard, as well. Okay, let's get into it because there's a lot to cover today. We're going to be talking about CGT. We're going to be talking about other stuff other than the CGT stuff, or we're going to start with the CGT and see how we go.
Option B. I think honestly, there's enough in here, and you've done a bunch of research that it's worth pulling apart. Nerd alert, totally nerd alert. But yeah, so CGT, the reason that we wanted to bring this to the table, obviously, like Goose just said, we have a tendency, or kind of our role, I think, in the world right now is digesting the things that are happening or the things that are in the headlines, because there's a lot every single week, every single day, things are changing, and trying to get to the bottom of what the true story is and being able to bring that and clarify that and share that with you. So I will also just say, because I don't have a plan to talk about this much later on as well, is that we have started a new content series newsletter. It goes out on multiple platforms called The Signal. That goes out once a week, where basically all of the key metrics across anything to do with macro, specifically in the sense of what the changes in the world mean for property investors. And we really wanted to do that because there's a lot of noise out there and it's hard to keep track of all the changes that are happening. So we put it together into this one dashboard that gets updated once a week and is sent as a newsletter as well to our email newsletter, as well as gets posted on socials as well. So we do that once a week, and I'm already finding that it's really helpful. Okay, who's going to pull it up? Look at this.
Look at this.
It's just a helpful, it's a super helpful digest of everything that's happening, particularly. And there's a summary at the bottom of like what this means for property investors. So if you've been wondering what all of the changes that are happening in the world, what are all the different metrics and how do they impact you as you're considering your wealth strategy, basically over the next year or so, it's a really helpful resource. We really wanted to just put it together because, like I said, there's not one other place you can really go to get this information in one spot. You can spend a lot of time reading the news and getting on everyone else's newsletters and watching all the like stressful stuff that comes up on social media. You can do that, or you can read this and get one digest at once. I just wanted to.
It's super valuable. It's such a valuable resource, and the reason we wanted to build this is, as you said, like is to empower people with better information. Better information leads to better decision making, and something that can sort the wheat from the chaff. So this actually started as a little project that I built for myself, and anyone who watches this pod or listens to this pod knows that I like to research and nerd out. I actually started building an intelligence dashboard for myself, and then we went, this would be so good for everyone to have, and so we adapted it. And you will see it's called The Signal. It's a macro intelligence dashboard for property investors. And if you want to get it, go to dashdot.com.au/The Signal. It is free. We update it every single week. So Gabby runs this every single week and publishes updated information, and it gives you the latest and greatest, most valuable insights for property investors from a macro point of view. And this is the most important thing to understand how to navigate this kind of environment. So it is super, 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 super valuable, and we encourage everyone to check it out. You can also subscribe, get it in your email inbox, so you don't have to go and check it on that website. But it's absolutely free. There's nothing to buy. And it helps you to become a more informed and more intelligent property investor. So go and check it out. Sweet.
That was a nice little unplanned plug. But I realized that we have a tendency to build things and then not actually tell people about them. Maybe that's just me. That's probably my bias. This is something that like we put a lot of work into, so it makes sense to like tell people about it. Anyway,
and we put work into it. We put work into it for good reason, because we want people to be able to make better decisions and have better insights. You know, like just on this, just a quick segue before we get into the CGT stuff. You were telling me just yesterday we had someone email us saying, "Help! Can you please help me sell a property before May 16th?" Because the CGT reform is coming in. And that's the kind of knee-jerk, response that you want to avoid. And the way you avoid that is by having better access to better information, better insights. And so to the extent that we can do that on this podcast, we will, and we do. And to the extent that the Signal now exists to give you a weekly pulse check on all of the stuff that we can't possibly fit everything into a podcast, and to do it more frequently, that's going to give you the insights you need. Now, let's get on with the CGT discussion.
Great. So, CGT, all that being said, CGT is becoming a very hot topic again. It kind of rears its head every couple of months and then couple of years as the budget rolls around. But we are having a lot of questions come through from you guys that are listening, from our clients, from family members, from our team. Everyone's going like, what does this mean for property investors? And like, does this change the thesis around property as an asset class? And so we basically heard this, and then Goose, you went full Goose mode on this week, went really deep in the data and pulled together the actual maths and what this was looking like in terms of the impact, assuming that the proposed changes do come through, because that's kind of what's come up in the last week or so, is that I think something was leaked. I missed this bit about something being leaked, but apparently something was leaked where it was like, it's almost certain that these CGT reforms are going to come into place from May 12, when the next budget is happening.
May 16th, I think it is. Yes. So exactly. So look, it's become a topic on everyone's lips, and I think there's a few different reference points around like why people are concerned about it. They're like concerned that all of a sudden they're going to pay heaps more tax, but I think the implication of that also is, does that mean that property investing doesn't make sense anymore somehow? Like I'm gonna have to pay more tax. That's even the inverse way that you should be thinking about it. It's not I'm going to pay more tax. I'm going to have less of a tax discount is actually the better way to think about it. Because what happens is you get a 50% discount on your capital gains tax. they're going to reduce that discount. So, okay, so you're just not getting as much of a tax saving as you did in the past. So it's even just a reframe on that front. And then there's at least some portion of people that are thinking, oh my God, if they bring this in, property investing's toast. Everyone's going to sell their investment properties. The property market's going to crash, blah, 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 blah. And there's all that kind of narrative that floats around as well. So for the people that are concerned about this, it's some version of like, oh my God, am I going to have to pay heaps more tax? Or, oh my God, does that mean that property investing doesn't work anymore? Or, oh my God, does this mean that the property market is going to crash because everyone's going to sell all their properties? And I think that here's the punchline. Like, no, right? Stop, calm down. If that's you, just chill, because none of that is specifically true. And I think even more broadly, the question that we need to ask, really the core question, is not, am I going to pay more tax? It's, what is my return on invested capital after tax relative to the alternatives? Because the question, or the position remains that if you want to invest, you want to invest for a reason. That reason is typically to advance the prosperity of you and your family. And so if you're questioning, oh no, this CGT changes are coming in, I'm not sure if I should invest in property, then necessarily the other part of that question is, I would be choosing to invest in something else. And by the way, not investing is also a choice, which is staying in cash. And that is also has significant downside. So you're effectively going to choose to continue to invest in property, or stay in cash, or invest in something else. And so then the question is, what is going to be better off? Like what is going to leave you better off? Does it make more or less sense right now to invest in real estate versus everything else? And that also necessarily has to factor in any risk of like, is the market suddenly going to tank because everyone's going to sell? Which, here's the punchline: no, it's not. Right? No, it's not, and no, they're not. And everyone relax. If it's all right with you, Gabby, I might just do a quick segue into a little bit of tax history.
Yay! Nerd.
Nerd alert. Okay, so
can I hold my coffee mug as you do that? Yes.
Yeah, you can hold your coffee mug, and everyone sit down and let me tell you a story about the history of capital gains tax in Australia. Because we didn't always have, that's why everyone's here, right? So it's story time with
tax story time, the best.
Hey, it doesn't matter, right? Hey. So we didn't always have the CGT structure that we currently do. So there was capital gains tax, but up until 1980. So there was the pre-CGT era. So that was before 1985. So before 1985, Australia had no general capital gains tax. Most capital gains were entirely exempt from income tax, creating a significant gap between the taxation of labor income and investment income. So to put that simply, if you weren't generally disproportionately taxed on your capital gains, so you could actually make more money just by investing and not working, right? So that was the disconnect between the taxation of labor income and investment income. And then in 1985, the Hawke-Keating government introduced CGT as part of a broader tax reform package. The original design used inflation indexation. I think this is so interesting. So that means the cost base of an asset was adjusted by CPI. So you were only taxed on the real gain above inflation. An averaging mechanism also prevented a larger one-off gain, pushing you into a higher bracket. I think that is really interesting, because I actually think that actually might be this was in 1985. This is in 1985. So it was an inflation indexation. So the cost base of an asset was adjusted by CPI. So you were only taxed on the real gain above inflation. I think, as someone who waxes lyrical almost every day about, certainly every podcast, about monetary debasement, CPI, inflation, all of this kind of stuff, an inflation indexation to me, I think, is a really interesting idea. I think it's a really interesting idea. And so as part of that, any assets acquired before 20th of September 1985 were permanently exempt. So that's the pre-CGT assets. So broadly, in 1985, they introduced the inflation indexation, right? So the cost base was adjusted by CPI, which I think is actually super interesting. Then in 1999, 50% discount, the 50% discount on CGT replaced the inflation indexation. So that was the change. Now, the rationale was to make it simpler, make it more competitive, to attract more investment in Australia, blah, 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 all this kind of stuff. But it was largely very political. Now, this is so let me just say, I'm the last person in the world who wants to pay more taxes, right? But you may find me saying some things in this podcast episode that may make you question that position that I have. Because I think that the 50% discount is great when you're on the receiving end of it. But actually, it's reasonable to ask, is that even the right structure? Now, the interesting thing about the inflation indexation is, and I did a bit of digging into it. So if you, so the average, after the CPI indexation, the average capital gains that you would pay would be roughly between 35 and between 30 and 45%, depending on the holding period and depending on the inflation rate. So that would be the effective discount that you would get. So if we just say 30 to 45%, if we had an inflation indexed CGT tax policy still, the average discount would be roughly 30 to 45%, depending on the holding period. The 50% flat discount gave everyone more of a discount than indexation, and particularly during low inflation periods, right? So what that did is that again went back to disconnecting the relationship between investment gains and labor income. So there was a structural tax preference for capital gains over labor income. I've said plenty of times on this podcast, you're better off getting a capital gain than earning more income, because if you just increase your income, then you'll end up paying 47% tax or whatever on your income if you earn high enough. But if you if you pay CGT, because everyone complains about CGT, even though they get a 50% discount, everyone's like, oh my God, I don't want to sell a property because I'm gonna have to pay CGT. But after you get the 50% discount, you only end up paying 23.5% tax on that effective income. So if you sell a property and you've owned it for more than 12 months under the current tax regime, and you get the 50% CGT discount, then your effective tax rate on that 100 grand gain, right? So if you sell a property, make $100,000 gain after 12 months, then the effective tax rate on that would be about 23.5%. So you pay 23,500. That's way less than income tax, right? So it is better. You're better off financially to deploy your capital into assets than to work, right? And so again, I'm the last person in the world who wants to pay more tax, but it's also interesting to think that the predecessor to the current regime did land you in about the 30 to 45% discount range anyway, right? So anyway, I just think that whole structure is interesting, and I think there's even an argument to say that the inflation indexation could even be a better move. I think it's super fascinating.
Yeah, it's interesting because I've got a note later that I wanted to cover a bit around why, what are they trying to achieve with changing this?
Yeah.
And I think it's interesting to think about the being taxed on capital gain from an investment being seen as less, I don't know,
productive,
desirable, or something less productive for than being taxed on income. And it's the argument being that it's the current structure is that it is more appealing with the current discounts to try and grow your wealth through capital investment than it is to do it through labor income, which is that sounds obvious to me as an investor, that you would want to try and find ways to maximize your capital that's not using your life to do that, if that makes sense. So it's
yeah.
No.
I didn't mean to interrupt, but I think it's an interesting point, and we're sort of way off in the philosophical, and we'll get back to the actual specific reforms and what they mean for the everyday investor. But I think it's an interesting point. I mean, if you go back to the inflation indexation, the idea around that was because prior to that there was no capital gains tax, right? And so you get taxed on your income, you'd have income tax, but you wouldn't have capital gains tax. And so, for lack of a better term, unproductive capital would flow into assets, right? And people would have more incentive to park their capital in assets rather than have it flowing through the economy and stimulate a better economy. And a plumber might get taxed at 47% marginal tax rate, but then some investor would sell a property and pay 0%. So then they introduced and so there was a big disconnect between the tax treatment of those two effective sources of income. Because when you sell a property, let's say just for example, you sell it for $100,000, not counting all the selling costs and everything like that, you receive that as income. Like that's actually what happens is you receive a bunch of cash in your bank account. That's not any different from receiving a paycheck. It's income. It's, from my point of view, it's investment income. Because that's how you're collecting the cash. And so it's interesting to think about that, the relationship between those two ideas and what is actually better holistically. And it's probably better holistically to have the two things fairly well married up, realistically, right? Because then you've got the opportunity to deploy your capital, and your capital can go to work whilst you're asleep. That's still true, right? It's just that when you claim the income from that work that your capital is doing, it's going to be taxed in the same way as your income tax. Now, we could then significantly argue that income taxes are way too high, right? So there would be a broader discussion around, taxes are too high anyway, right? But just from a concept basis, is there a reason that we should have those two things disconnected? And so I think a big part of this, I think there's two parts to this. One is to kind of bring that back in line, because the premise is that because of the disconnect between the tax treatment of labor versus the tax treatment of assets, it is more capital is flowing into assets, which is making them less affordable generally. And I think that may be true to at least some extent, right? So, I think that may be true to at least some extent. I think there's far greater reasons that property prices are going up than CGT, right? Let's just be really clear, right? And the government's already said that as well. They expect that the CGT, let me try and find my data here. They expect that the CGT changes are going to have like maybe a 4% aggregate impact on property prices. Let me just try and find my problem with having too much data is you can't find what you need when you need it. So yeah, I think from what I looked at, the modeling is that they expect that there'll be somewhere between a 0.5 and 4%. So Treasury modeling suggests that combined changes to the CGT discount and negative gearing, so I was talking about that too, would reduce house prices by just 0.5 to 4.5%. Independent economists estimate the CGT discount reduction alone at roughly 1 to 4%. So pragmatically, right, it's not going to change property prices that much, but the premise is that at a high level, there's that disconnect between labor taxation and asset taxation is causing more capital to flow into assets, which then can create a greater disparity of affordability. Now, the other thing is income, right? The government's been running huge deficits. And I think that it's like something like they're expecting over the next 10 years to collect something like $274 billion from the CGT adjustment, right? So basically they'll collect, $250 billion of new income by adjusting the CGT tax discount. And so there's a big income piece here. They're trying to balance the budget as well. They keep running huge deficits. And so, they can dress it up as an affordability. Let's do something for the greater good. But realistically, it's just so they can balance their budget and keep spending too much money on stupid government programs that don't do anything, right? So I think that's the kind of the main driver. But we should also talk about what even is the discount, right? Because what even is the discount reform, should I say? Because the current CGT discount is if you hold an asset for longer than 12 months, subject to some other conditions, you can avail yourself of a 50% discount on your capital gains tax, right? So that means to say that if you were to sell an asset, and if in the selling of that asset, the gain that you received from the asset would push you into a higher tax bracket, you would get a discount of 50% on that marginal tax rate. So if it pushed you into the 47% tax bracket, you get a 50% discount on the 47% tax rate, which would then bring it down to 23.5%. And so what they're actually talking about doing is lowering the discount from 50% to, and there's two versions. One is 33%, one's 25%. So it's not going to zero. No one's saying like, oh, you're not going to get a discount anymore and you're going to pay full capital gains on every dollar. No, you're still going to get a discount. And so I think that people are over-indexing their fear of what this tax means. What do you think?
Yes. It's just interesting to get different perspectives, because I think CGT is one of those things that's like weirdly sensitive for people, particularly as it relates to like, should I choose property as an asset class to invest in? And so I think it will definitely have an impact. But as we'll go into the maths a little later, going through the different scenarios of like, if you are going to let this kind of deter you from investing in property, it's like, what are your other alternatives? Because I care about people looking after their financial future. And so you need to invest to be able to do that these days. Unfortunately, with the structure of our economy right now, if you do nothing, you're going to go backwards. So you need to invest to do that. And so the math that Goose has kind of you've done this week has been pulling apart, like, okay, what are the alternatives though? And comparing that return. I was going to ask, do you know if they are going to grandfather this? Like if they're...
Most likely, yes. Obviously,
yeah.
Go on.
No, because I think that the question that came through via email this week was around they're wanting... I'm butchering what they've said, but it's like they're wanting to try and sell before the budget because otherwise then...
Because they're worried that the grandfathering won't happen. Look, I think no one knows what's going to happen until it happens, right? So everything's theory until it's fact. So we won't actually know until because one outcome is they don't actually do a CGT discount reform. They actually might just say, look, it's politically unsavory. We don't want to do it. I don't think that's likely. I peg the probability at 70 to 75% that they'll reform the CGT discount. That being said, that doesn't mean that they're going to do it straight away, and we don't know how much. So it could be between 33% and 25%. Like it could go from 50% to either 33% or 25%. It's almost certainly not going to zero. Like no one's even proposing that. There's a chance that it could come in from the 1st of July, 2026. Most likely it's going to come in from 1st of July, 2027. And again, no one knows exactly. It still could come in this year, but most likely because by the time, they've got to kind of like roll out campaigns around this, they're going to change a whole bunch of stuff. Like the 1st of July, 2026 is really not very far away. It'll be a pretty quick turnaround. They may be incentivized to do it because I did just check and they're expecting the forecast revenue they plan to generate from this is around $21 to $25 billion per year. Now, that is a parliamentary budget office estimate, and we know that politicians don't know how to estimate. So TBC could be a lot less than that, right? Right, we'll see. But so most likely it is something's going to happen. So I put that probability of a reform happening at about 70 to 75%. Most likely it's going to be, in my opinion, it's most likely going to be 33% change from 50 to 33%. The bear case that I've got is that it goes to 25%, but even that's ostensibly fine. I think we can all just relax a little bit on that because it's like you're still going to make a ton of money. We'll walk through the maths in a minute. And I think that most likely, and again, this is not fact, this is just my opinion based on everything that I've researched and read. It's most likely, in my opinion, going to come in at the next financial year, so the 1st of July, 2027. And almost certainly it will be grandfathered. I think the political cost of it not being grandfathered would be extreme. I think that I think it would be unpalatable. And I think we need to look at the history of this a little bit as well. Labor have tried to implement CGT and negative gearing tax changes before. It's lost them elections. Right, it has severely lost them elections. Right, they've been totally smashed because they've tried to run election campaigns based on these kind of tax reforms, and they have not worked. The only reason, or one of the reasons that my probability analysis is so high for this at this moment in time, is because we're such a long distance away from the next election. So if they wanted to do something that was politically unsavory or politically challenging, but that was aligned with their ideology, and they want to do it as far away from an election as they can, meaningfully, which is do it sooner rather than later. So by the time they get to the next election, it's water under the bridge and people aren't talking about it as much. because every time they've tried to run an election campaign based on these kind of policy changes, they have been absolutely smashed. Now, what I would say is public sentiment around this topic has changed. So the times where they've tried to run election campaigns based on these promises, their sentiment has been different, right? And now, based on a lot of surveys, there is more appetite from the general public for this kind of a tax change because more people are feeling more shut out of the property market than ever before. And whether it is true or not, people perceive that this kind of a thing is going to make it more affordable. Now, to the point that I just made, even the government is saying that it is likely to only have a 1 to 4% impact on property prices, which is very marginal. Okay, and that is also not going to be evenly distributed in the locations we buy. We call them apex locations. So, in the lower tercile of suburban medium house prices, where there's also jobs, lifestyle, and relative local affordability, plus a bunch of other stuff, they're going to be disproportionately beneficial. They're going to be the disproportionate beneficiaries of capital gains anyway, right? So there's going to be more growth in that sector than other sectors. And so even if there is a 1 to 4% marginal decline in property prices, or a marginal impact is actually a different way to think about it on property prices. Marginal impact is different to decline. Marginal impact might mean that over a 12-month period, there is between a 1 and 4% less growth, not negative growth, just less growth. So for example, let's say the property market was going to organically grow by 10%, then a 1% impact on growth could mean that it only grows 9% and not 10%. Or maybe a 4% impact means it only grows 6% and not 10%. So when people hear these numbers, they go, oh, the property market's going to go down. It's like, no. There may be an impact on prices, but that impact may be seen in slower growth rates because the growth rates get impacted slightly versus a negative price decline. So, and again, it's not going to be evenly distributed. So some areas are going to be more affected than others. Typically higher priced markets, typically oversupplied markets, they're going to be the worst. They're going to be the worst hit, but they're going to be the worst hit anyway, right? So if you're buying a well-selected asset in a well-selected location, you don't really need to worry about that kind of stuff anyway. Anyway, I lost my path. Where are we?
Well, I was just thinking, I want to do like a choose your own adventure here because we have two paths. We can either go into the math because we have a whole analysis report that we can share where we're going through comparing this scenario, how it is currently, the proposed scenarios, as well as other asset classes. Or we can have a bit more of a conversation around like what they're trying to achieve here and why, and if this is actually solving that.
Let's do both. Let's start with some of the maths. And why don't I share the report and I'll go through a couple of key points in here, and then everyone can see the report, and then you can get it yourself for free.
For free.
So let me share my screen.
Guys, I see all of you joining us live. I'm going to drop it in the chat as well so you can follow along, but we'll pull it up on the screen as well.
So this is the analysis that I put together. What happens if the CGT discount is cut? And if you want to get access to this yourself, you can go to tools.dashdot.com.au/CGT analysis. tools.dashdot.com.au/CGT analysis. We will include this link in the show notes or in the pinned comment on YouTube. And if you're here live, you get the link right now and you go to check it out right now. It's not gated. You don't need to sign up to anything. You don't need to put in an email address. You can share it with anyone you like. It is free. There's no obligation. There's nothing to buy. Just go check it out, right? It's going to help you to understand. By the way, I shared this with our team at Dashdot last night, and it was met with roaring feedback and applause. Like everyone was like, "Oh my god, this is absolutely freaking amazing!" Because the answers, and that's not me being like, "Oh, cool, Goose, nice report." What it actually said to me was, "This is really valuable and important information if you really want to understand what's going on," and that to me is success, right? So. I'm not going to read this whole document through. You can read it yourself, but you can see here, and this is all broken. This is all part of the deeper analysis. I think that the most likely scenario is that there's a 33% discount as the new discount, not 50. May 12th is when the budget is going to be announced. There's a 75% probability of reform, and the $21 billion cost to budget should actually be revenue into the budget. So what I did is I modeled a scenario where you had $150,000 in savings. And the question that most property investors are asking right now is simple. Does the CGT discount cut change whether property still makes sense as an investment? And so what I did is I worked through this in a variety of different scenarios. Okay. So the options that are being discussed at the moment, it's a 50% CGT discount, and that means the effective tax rate is 23.5%. That applies to all assets held 12 months or longer. Now, the likely scenario is a 33% CGT discount, which would mean you'd have an effective tax rate of 31.5%. Now, let's just pause there. So most people are going to be paying 31.5% or higher in tax if they're investing in property, from their income tax. So 33% CGT discount actually just puts your investment income, i.e. the gains that you get from selling your assets, relatively on par with a reasonable tax bracket, basically. And that's assuming that the gain pushes you into the highest marginal tax rate, and then you get the discount. Now, the thing is that the CGT discount, they're proposing that it'll only apply to investment properties. It's not going to apply to shares. In a previous episode, I said they'll have to apply to everything. Well, turns out they don't. So, yeah. And almost certainly the existing assets will have their existing tax treatment. And it's easy for that to track because it's recorded when things are bought. So now the bear case scenario is that we end up with a 25% CGT discount, which then gives you an effective tax rate of 35.3%. Again, not that bad. Right? A lot of people are paying between 30 and 42% income tax rate anyway. So this is the context that we really need to have. And then shares and other assets, 50% CGT discount's not going to change, right? So fine, all good. So then if you've got $150,000 to deploy, what is the best way to deploy that capital in a way that it's going to make the most amount of sense, even if property is the only asset that gets hit by the CGT discount reform? That's an interesting question. Now, I looked at two scenarios here. So we very proudly at Dashdot, we have bought well over 2,700 properties, and the average growth that our clients have achieved in the first 12 months, that's averaged of over 2,700 properties, is 21%. That is wild, right? But I included that for context because I've modeled two scenarios, right? So if you get the kind of average year one growth that our clients have gotten, or if you get the national average, which is about 7%, okay? So then I compared property versus every other asset class. So we've assumed an 85% LVR, and you can see all of the scenarios broken down. How did I arrive at 85% LVR? What types of locations, all that kind of stuff is all in this report. But this is where it gets really interesting. If you purchased a property, if you're a Dashdot client, basically, and if you achieve the average of 21% capital growth on a $500,000 asset that you put $150,000 into, and again, averages are averages, so that doesn't mean that every Dashdot client gets 21% growth in the first 12 months. That's the average, right? Then your pre-tax return on invested capital would be about 70%. That's not, just use that as a generalization. If you bought the national average property, right, i.e. it grows by 7% on a $500,000 asset, and you've used 85% LVR, your year one gain would be $35,000, and your pre-tax return on invested capital would be 23.3%. Now, both of those are significantly better than the ASX, where you wouldn't get leverage on it, but your pre-tax return on invested capital would be about 10.6%. S&P 500, your pre-tax return on invested capital would be 12%. Gold, your pre-tax return on invested capital would be about 8%, notwithstanding the last 12 months have been very good for gold, but we're looking at a long-term average. And bonds and term deposits, your pre-tax return on invested capital would be 4.5%. So in every scenario, property massively outperforms every other asset. So what happens then if we compare over a 10-year time horizon, if we compare over 10-year time horizon, the allocation of capital into a property versus the ASX versus cash. And what we're going to do is we're going to assume that we only get 25% CGT discount. So that's the bear case. And we're going to assume that you only get the 7% per annum national average growth rate. So this is kind of conservative. This is not assuming that you get Dashdot style returns. And it's assuming that the CGT discount gets cut from 50% to 25%. So I'd say this is pretty bearish, right? In that scenario, and I'm not going to read through all the numbers here, but in that scenario, your property would produce around 159% return on invested capital over a 10-year period. The ASX would return about 105% return on invested capital, and cash would return about a 33% return on invested capital if it's in a high interest savings account. And that's subject to real rates of return and all of that kind of stuff. So this is interesting because even in the worst case scenario, property still significantly outperforms it, and it outperforms shares or cash or anything else you might seek to invest in. But the other part of this is you need to consider the risk-adjusted return, and you also need to consider the debasement effect on debt. And I'll just talk to those for a moment. I'm not going to continue to go through everything in the report. We can dig into any stuff if you want specifically. The thing is, you might go, okay, well, I can invest in the ASX and I can get 105% return on capital, or I can invest in property and get 159%. Bearing in mind that in the property scenario I've outlined, that's the bear case. Right? That's kind of like if you only bought an average, performing property that didn't go that well, and if the CGT gets cut to 25%, yada, yada, yada. The thing is, equities are far more risky and far more volatile. With all of the changes in the environment with AI and everything like that, businesses and industries are getting severely damaged, right? Now, does that mean that if you invest in a broad index, everything's going to get smashed? I don't know. But the fact of the matter is stuff is getting hammered. We've seen the whole software sector, legal sector, all of this kind of stuff have billions, tens of billions, hundreds of billions of dollars wiped out because Claude released an update or a skill, right, that you could use on the platform. So the volatility and the risk in equities is significantly greater. So when you're thinking about the return on invested capital, you actually need to think about the risk-adjusted return on invested capital, not just the nominal value. So it's all well and good to say, okay, over a 10-year period, 105% for the ASX 200, 159% for an average property in a bear case CGT scenario. But which one is more or less risky? Because I can tell you that the stock market is incredibly volatile. When a guy with orange hair tweets something radical, the market just goes bonkers and everything tanks, right? And that can be very problematic. That's also why you don't want to have leverage on your equities. But that's not going to happen for property, right? So you have an inherently different risk-adjusted return profile on these assets. And the other thing as well is you actually need to consider the effect of, where is it in here? You actually have to consider the effect of debasement, monetary debasement, and CPI inflation, and the erosion effect of inflation on your debt as well. Because with property, one of the big benefits is the leverage that you get on it. And then over time, inflation is going to devalue the cost of your debt. And that's actually going to give you a better return overall. So if we look at just a quick summary before I stop waffling on ad nauseum. So if we look at the year one after-tax return on invested capital for a dash dot property, in the current environment, it's roughly 53.6%. It's actually a little bit higher than that, but this is just modeling for the purposes of this document. And in the bear case, if there's 25% CGT discount, not 50%, you would get 45.3% return on invested capital. Year one after-tax return on invested capital, if you just get an average property with a national average growth, currently it's about 17.9%. Bear case is 15.1%. Now, these are the after-tax return on invested capitals. Now, it hasn't factored in negative cash flow, but you get the idea. And so the best alternative is the ASX, right? And in any scenario, property is going to beat it by about 8. So about between 2 and 7 times, basically. So the ASX is going to track at about 8.1% after tax. And so so the best alternative is still about 5 to 7 times worse than buying property. So the point here is, like, I don't think that there is, if we look at this numerically and mathematically and think about it on a risk-adjusted, volatility-adjusted basis, I think there's a lot to be concerned about. Now, some people might be concerned that they're going to, if they've made $100,000 gain on a real estate asset, in the current version of events, they're only going to pay, we'll call it $23,500 in tax on that. And that might increase from $23,500 to $33,000. Okay, but we're not talking, your asset's suddenly not going to be underwater, right? Yeah, your tax bill is going to be higher, but you got to remember that you pay that tax bill after you've received the gain. So a lot of people, they're like the dragon in the Hobbit, just like hoarding all this gold. It's mine. They're like, They're like, Gollum, my precious. They've got these gains. And it's like, okay, you've received the gain, now pay the tax. It's fine. It's just part of the sport. And I just don't think that people need to be so caught up with the fact that there's going to be a marginal difference in the amount of tax you'll pay. But the returns, the end state returns are still significantly greater than any other asset you can invest in. And it's a better performing asset on a risk-adjusted basis by a long shot. And so with that worldview, I mean, I think it's a nothing burger, honestly. I just think, okay, cool. My future returns are going to be taxed at a slightly higher rate, and I'm still going to be significantly financially better off. What's the problem?
So how do you come around to the concept that, like, the government are arguing that they're putting this in place to solve housing affordability, right?
Yeah.
Does it?
I don't think so. Like, I mean, by their own admission, they estimate the impact on prices, as I mentioned, to be between 1% and 4%. And again, impact on prices could just mean slightly slower growth in aggregate. I don't think it does really a lot to improve affordability. In fact, it may actually slow down new builds, which would actually decrease new supply market. So it could actually make affordability worse, I think. Almost certainly it's going to make rents go up. Almost certainly there's actually going to be less turnover of stock. I think one of the impacts is that people might hold assets longer because they want to balance out that return profile by holding it for a longer period of time. So they're paying less incremental tax along the way. So what you actually may find is stock on market drops. Less people want to sell properties, which could have the effect of actually driving prices up incidentally, right? So I don't think it's actually going to fix affordability. Yeah. And also it could actually lower building starts because there could be less people wanting to build assets because there's less incentive to do so. So I actually think, and this is actually that's not me just making that up. That was the Master Builders Association or the HIA or something like that. Actually, I've got it here. So industry modeling from the REIA, HIA, Master Builders, and the Property Council suggests that combined CGT and negative gearing reforms, so that does include negative gearing reforms, which are not necessarily on the table at the moment, but suggests that combined CGT and negative gearing reforms could reduce new dwelling starts by approximately 45,000 over 5 years. Now, this is a really interesting point. Let me segue a little bit, right? So they're saying that, and again, that is combined CGT and negative gearing, could reduce new dwelling starts by approximately 45,000 over 5 years. But did you know, Gabby, that the building completions to population growth ratio is 3-1? Actually, population to building completions ratio is 3-1. So population growth over the period of 2023 to 2025 was approximately 1.5 million people. Housing completions was approximately 527,000. So we had 3 times the population increase than we did the building completions, housing completions.
Yeah.
Now that's a pretty sobering statistic. Now, one might say that we don't need a house for every person in the country, and that is true. That is true. But also household sizes are not 3 people. Household sizes are actually reducing. They went from 2.7 to 2.6 to 2.4, and I think they're down around 2.2 at the moment. They keep getting lower. And so what that points to is we have an increasing deficit between the amount of people we have in the country and the amount of houses we need. And these kind of policies can actually disincentivize people from wanting to invest in the real estate market. So if you think about like institutional level investment, they may seek to do other things with their capital. But for a private investor, I think that still represents a significant opportunity. So I don't think this is going to actually solve anything to do with housing affordability, housing supply. I don't think it does anything like that. And I think that the funny thing is this policy is going to disproportionately benefit people who have already invested, for sure. You've already invested and it's almost certainly going to be grandfathered. If it's not grandfathered, I'm going to be extremely shocked. Now, I could be wrong, but I would be extremely shocked if it's not grandfathered. I don't think that there's 101 reasons why they should grandfather it, and very few reasons why they shouldn't. So almost certainly it's going to be grandfathered. So everyone who already owns a property is going to be disproportionate beneficiary of that. But of course, it's the only way to do it. And then on a go forward basis, it's going to normalize out anyway. So I don't think it's really going to change anything. Does that make sense?
It does. I think it will have an impact from, this is the thing with all of these policies. It's like it boils down to demand and supply at the end of the day most of the time. And I think it will have a slight impact on the demand. Like even the reason that we're having this episode today is because there are people out there that are questioning whether they should invest in property. Like there's going to be a lot of people that don't buy an investment property off the back of this. Like I do think that that's going to happen.
I mostly disagree with you. So on a very either you're frozen or I've frozen. Well, if you're watching me live, I am unsure whether it is Gabby or I that is frozen. Stand by while we resolve this technical issue. Uno momento. I'm going to assume that it's Gabby. So I'm going to continue on. So I disagree with Gabby to some extent, and I'll explain why. So I think in the short term, news like this can cause people to feel some level of distress, right, or concern. And that can, at the margins, cause some people to delay their investment decisions. But on the macro, I don't think it changes anything. You know, we have such a disparity between housing supply and housing demand that even if there was 1 or 2 or 3 or less demand for property because some people at the margins are like confused or unsure what to do because of the CGT discounts, that's not going to meaningfully impact anything. We have a current housing deficit of between 200,000 and 300,000, roughly. I think it's closer to 300,000. KPMG forecast that the deficit could reach 400,000 housing deficit of 400,000 properties by 2028. So, there's 640,000 households that are unable to access affordable housing. So that the volume of demand is so large that even if some people get it cold feet, I don't think it's going to stop people wanting to buy. Gabby, I just continued on. So I think that worked out because I wasn't sure if it was you or me that was frozen. So it's just saying, it's okay. I'm just disagreeing with you in principle because I think that in the short term, people may be a little bit perturbed by this. But the fact of the matter is there's such a deficit between the current supply and the current demand that even if, say, 5% of actors said, oh, I'm not sure about this, there is a deficit of approximately 300,000 properties at the moment. And KPMG forecasts that the deficit could reach 400,000 by 2028. There's currently 640,000 households that are unable to access affordable housing. As I mentioned, the population to completions ratio is 3-to-1, which is crazy. The building approvals year to February 2026 was 196,500, and the required run rate is 240,000 a year. So that's 81,000 homes below target just in the last 12 months. So this is, there's a crazy amount of demand. Now, also on the other side, from an investor perspective, so that demand is going to keep a floor under property significantly. I think that the tax issue is it's at the front of everyone's mind because the media banging on about it, and nobody likes to pay more tax. But it's so downstream. It's such a lower order impact on the property market than so many other things. To your point, fundamentally, demand and supply, right? And there's such a gap in that there's such a pressure between those 2 points that creates the floor. But then let's think about it from an investment perspective. So rents are almost certainly going to go up. The University of Melbourne research estimates that removing the CGT discount entirely could push rents up by approximately 1.3%. If investors hold properties for longer, which is known as the lock-in effect, because investors don't want to turn over their assets as quickly because they're going to pay slightly more tax or they have less of a tax discount, fewer properties cycle through to new renters. So if some marginal investors exit, that's fewer rental properties provided. Industry modeling from REIA, I've covered that off, could reduce new dwelling starts by 45,000 over 5 years. So national rents grew by 5.7% in the year to March 2026, and vacancy rates remain near record lows. So KPMG projects above trend rent growth of approximately 3.5% through to 2027. So broadly speaking, I think that if rents are going to continue to go up, if less people are going to be turning over their properties, if there's a structural deficit between supply and demand, if there is less incentive for people to do new building starts and less building approvals happen, then I don't actually see property prices going down at all. Or to put this another way, if we wanted to solve the affordability crisis, one of two things would need to be true. Either people would need to earn more money or have access to greater amounts of credit, or property prices would need to come down. Or stay flat while wages grew, right? So there's more than two things in there, right? So, but you've got to look at that dynamic. Affordability is people's ability to afford to buy the assets. So they either need to have more money or the assets need to be worth less relative to the amount of money that they have. And so I don't think property prices are going to go down. I also don't think wages are going to suddenly spiral massively upwards. In fact, I think property prices are going to go up, and I think that wages are probably going to stagnate, right? There's far more evidence to support the idea that wages are going to stagnate than they are going to balloon because of all of the AI innovation that's happening at the moment. As companies don't need to. So if we just switch gears a little bit, there is not as much job loss from AI as people have been talking about. The impact is being felt in less hiring. So this is just in the same way that when the government says there could be a 1 to 4% impact on property prices, the inference there that people would have in their own mind is the prices are going to drop by 1 to 4%. It's like, no, it might just mean that there's 1 to 4% less growth. So when people say that jobs are going to be taken by AI, that doesn't necessarily mean that there's mass firings, although there have been plenty of those. It doesn't mean that necessarily there's going to be mass firings, but there could just be a mass not hirings. And that creates a big impact as well. And so when there's less hiring and unemployment increases or underemployment increases, then there's less incentive for businesses to increase wages because there's less competition for the employees they need, because they don't need employees as much as they used to, because they can build better systems, right? And so this in and of itself points to the fact that wages probably aren't going to go up significantly. So when we talk about rents going up, what we're actually talking about is rents taking up a higher percentage of people's income. That actually drives affordability down. So housing costs will increase relative to incomes. Overall affordability will go down, which is also why it's more important than ever to make sure you get on the right side of the ledger and make sure you're on the asset owner side and not the consumer side. Because unless you can get your capital to work for you, you cannot work hard enough to outpace the degradation of your cost or your income potential to afford your preferred way of life. You can't outrun that degradation so just by earning an income alone. So you have to put your capital to work. So if you want any hope of prospering and having a better future than you do now, it's super interesting. Then you need to invest. And it's super interesting as well. You know, we were talking to my parents. Obviously, we're in Australia, visiting family, doing all that kind of stuff. We were talking to my parents about, they're boomers, right? And they were talking about how they bought a property and how they had to work hard. And everyone says the boomers are bad news because they stole all the wealth. And they had to work hard. They had to save. They bought their first property. They had no furniture. They slept on the floor. They had a pizza. They ate pizza on the floor. They made sacrifices. And it is true. They did make sacrifices. But the cost of living relative to the wages. And as I astutely reminded my mum, I was like, you bought a house like 1 times dad's income. So yeah, you had to make sacrifices, but you can't buy a house for 1 times anyone's income now. Like it's just not possible. There are if the average house price grew, actually I've missed the stat, so it doesn't matter. But if someone wants to buy a $600,000 house now, not many people earning $600,000. Like $600,000 would be a cheap house, right? That's a cheap property to buy for most people. The average house price in Australia is about $1 million. If you're buying a $600,000 price, your house, you're buying something that's significantly less than the national average. That is most people. The average household income is $100,000, not $98,000. Called $100,000. That's 6 times. It's or 10 times the national average income to the national average national median house price is 10 times. So the trend is directional and strong, and I think that people just need to understand that these little distractions along the way of, am I going to pay an effective tax rate of 33.5%, or sorry, am I going to pay an effective tax rate of 31.5% on my capital gains versus my current effective tax rate of 23.5%? That is such a minor thing to be concerned about, when in the grand scheme of things is, if you don't get to work and if you don't deploy your capital into the best possible assets that you can find, which provably and mathematically, if you go to the report that I've put together, it shows you provably It is residential real estate in Australia. It's the best risk-adjusted return asset. You will get the best nominal returns. And then when you have the risk adjustment element on top of it, it is phenomenal. If you're not deploying your capital into the best assets that you can find, then you are leaving your life on the table. And I think it's like people focus on the wrong things so often. But anyway, what do you think?
I was thinking about kind of what I started saying earlier around like what they're trying to achieve by rolling this out, other than like political support and fanfare. But a lot of it, I think the argument is that it's going to, obviously the argument for housing affordability, which we've just been talking about, but also around intergenerational wealth inequality. And I think particularly like if you compare just like the two modes of taxes, it's like if somebody earns $100,000 through their wage, I don't know the tax rate on that right now, but like they'll pay a certain amount of tax. If someone earns $100,000 through capital gains, with the current discounting, they will pay less tax, right? But in that situation, someone that has the deposit and the capital to actually make a capital gain, they get more of the benefit than someone that just has a wage, because they already started with the capital.
Yeah. So I think actually it's fairer. So I actually think that it is fairer. Like if we want to talk about equality and fairness, right? Then it is reasonable to take a position that someone who is, let's say they've just started out, right? They're 20-something years old. They don't own any assets yet. They're trying to get ahead. So they're not an asset owner. They don't have a big pile of cash to be able to go and invest in a property or anything like that. They're just trying to get ahead. And they're getting taxed at, let's call it a third of their income, just for simplicity's sake. They're going to get taxed at like 33%-ish of their income. So they're getting taxed at a third of their income. But someone who is already wealthy may have enough capital to be able to deploy that capital, and their effective tax rate under the current regime is 23.5% on that gain. Well, if you just think about that from a fairness and an equality perspective, I think that most people would reasonably agree, if you're not sitting at home being a greedy little bastard, right? You would probably say, okay, that doesn't seem fair, right? That doesn't seem fair. Why is it that someone who has the advantage of already being wealthy get more tax breaks than someone who is trying to build wealth? Now, this is said as someone who runs one of the largest property investment companies in Australia, right? I'm not sitting here saying less taxes for property investors. I mean, no one wants to pay more tax, right? Like I get it, right? And you know, it's more money out of your hip pocket. But let's think about fairness. Let's think about fairness and equality for a moment. This is also why I don't have a problem with it, because I think that, and look, the vast majority of people that have built wealth have done it off their own back. The amount of people who are wealthy from intergenerational wealth transfer is very slim, versus the amount of people that are self-made. Most people build their wealth independently. That's the statistics. And so the strong argument would be from someone who has built their wealth. It's like, well, I've built my wealth. I deserve it. I agree. But that doesn't also mean that just because you have a large pile of capital, that you suddenly should have earned the right to pay less tax on that than somebody who hasn't yet got the capital. So to a decent degree, like I think that the normalization of the taxes between taxes on assets and taxes on income is net probably fairer for society. Now, do I think that the tax percentages are correct? Do I think that the amount that people are getting taxed is correct? No, I don't. No. And I think that if you just took a position where you said, CGT should equal, the CGT tax rate should equal, one way you could do that is you could say that the CGT tax rate is going to be equal to people's normal income tax rate on a regular basis, for example, on a full-time basis. That would have problems because then people might not be working full-time or whatever. But just as conceptually, if someone was paying 33% tax on their income, they sold an asset and they paid 33% tax on the asset, you'd probably say that's probably fair and fine, right? The issue comes when you sell the asset and it pushes people into a higher tax bracket, blah, blah, blah. But I think that most people would say that that is fairer. Now, is 33% of your income an appropriate amount of tax to pay? Is 47% of your income an appropriate amount of tax to pay? That's the big question. But conceptually, if we just take a step back and say that there is a young person trying to get ahead and they're paying 33% tax on their income, and then there is someone who is wealthy enough that they already have capital and they're making a significant gain on their capital and they're only paying 23.5% tax on that. Does that seem fair? No, I don't think it does seem fair. So from a social equality perspective, fine, all good. And I actually think that we all have a role to play in bringing equality into the society and creating the society we want. Now, this is not a political position. I am not pro-labor. Let's just be very clear, right? I'm not pro-labor. I think that taxes are way too high. I think that there is creeping socialism in our society. I think that governments don't know how to run budgets. I think there is so much fundamentally wrong with the current status quo of the political and economic environment. And all of that can be true, whilst I can sit here and say, I think that fairness is good. Economic fairness is good. I think that is good for society. Just in the same way that property investors provide a social good by providing rental accommodation to people who need it. Because if you just did away with all property investors, if you said, right, bang, property investors out, not everyone can afford to buy a property. Everyone's like, oh, then everyone would have a house. No, they wouldn't. Property investors make up about 33 to 35% of all property ownership. 33 to 35% of properties would go onto the market. That'd be soaked up by all the pent up demand. Prices basically wouldn't change. We could do a whole episode on that. I've looked at it. The price elasticity would pretty much bounce back to normal straight away, even if you sold all of the investment properties overnight. And then there would be all of the rest of the people who can't afford houses still not owning houses, because there's not enough properties. Even if we sold them all, you couldn't give them away and have enough houses for everyone. So that you just have a bunch of homeless people. So homelessness would go up and there'd be a crisis. So property investors provide a social good. And I think that we have the obligation to uphold that part of the social contract, that when we provide accommodation to our tenants, that we're providing good quality accommodation and we take care of our tenants to the extent that they take care of us. I think it should be a two-way street. I think that, for example, in Victoria, I think the pendulum has swung too far in the direction of tenants' rights. And I think that, and that's not a perspective of like, I'm anti-tenants. I just think it's not fair. I think that the pendulum has swung too far. So I think we all have a role to play in creating a fairer and more equal society. And this is an example of that. I don't think we need to sit around and cry about the fact that we're going to go from, on a $100,000 gain, go from being taxed $23,500 to being taxed, $35,000 or whatever it is. I think that's so $31,500. I think that's so inconsequential to the broader scheme of things when the real returns, particularly on an inflation adjusted basis, mean that you can rapidly accelerate if you can get on the right train. And that, by the way, that's the prize money you get for using your intellect to make better decisions. Because you can have two people that earn the same amount of money. Let's say that two people start the same career at the same place. They follow the same career trajectory. They start on an entry level income, and one of them goes out and parties all the time. The other one stays at home and saves money. They continue on their path. They get promotions at the same time. Their income increases at the same rate. One of them gets stuck on the hedonic treadmill, continually upgrading their lifestyle. The other one continues to save diligently and invest in real estate. Now, fast forward 10 years. Person A, who's been more diligent with their capital, given the same economic opportunity with the same job and the same career progression, would be several orders of magnitude, 10 to 100 times wealthier than the individual who had spent all their money and made poorer decisions and didn't invest. So the returns that you get from investing, that's your prize money for using your intellect and making better choices. And I think that the prize that you get is you get your capital to work for you. You get to build massive amounts of wealth. Millions and millions and millions of dollars. That's what you get, right? That's what you get for being smarter and for choosing to allocate your capital intelligently and not just burning it on things. We don't also need to cry about the fact that we're not getting huge discounts on those gains, because you're still going to get bloody wealthy. So I think everyone needs to relax. And by the way, I don't think it's going to cause, just whilst we're on this, I don't think it's going to cause a mass exodus of people trying to exit the market. I don't think it's going to cause. I don't think it's going to cause really anything. I think that some people are going to be concerned about it in the first instance. I don't think that's going to change. Most people are not going to sell because grandfathering is almost certainly going to stay in place. So that all the investors are going to keep 50% discounts. They're less likely to sell, actually. So it's going to create less turnover, and that is incidentally going to tighten supply and probably push prices up. So then you're going to have people rushing in, well. Like there's all these kind of dynamics that actually point to the fact that prices are probably going to rise significantly off the back of these announcements, because the people who own assets, like let's say that the implementation date is the 1st of 2027, the people who own assets, they're going to be like, well, geez, I've got this asset that carries with it this tax benefit. That constrains supply even further. So then that pushes up prices because supply is tightened. Then you got people who want to rush into the market to be able to get a property before the tax implementation date. That's going to drive more demand. That's going to push prices up higher, right? And then what's going to happen? It's just going to be a new ceiling. So from there, the tax policy will come into play, and then people will go, well, I guess I still don't have a better option than to invest in real estate, or I still need to buy a freaking home, right? So there's still going to be the demand. Prices will continue to march upward, and nothing will change. So I don't see a mass exodus. I don't see a collapse in prices. I don't see a significant change in affordability. And I think the government's already admitted that in their own fine print. I think people just aren't paying attention to it because it is a socially palatable discussion to have, to say, look at this. This is going to help affordability. If you just say anything is going to help affordability, it's going to get public support, even if fundamentally it's not actually true. What it does do, sorry, I know I'm waffling on here. What it does do is it puts more money into the back pocket of the government, theoretically, right? So they're going to collect about $25 billion a year, they think, from the reduction of these CGT discounts. They'll collect $25 billion more a year. Now, to the extent that can be used for social good, great. You know, maybe they could invest that into healthcare or teachers' wages or something like that. But they probably won't. They'll probably spend it on some crap, right? And keep running stupid deficits that we then all have to pay the price of when cost of goods and services goes up because of monetary debasement, which, by the way, is a far more significant impact on property prices than a minor at the margins tax change.
I'm just thinking through, like, that, did you say 25 billion estimated? Yeah.
Yep.
So I think, again, like, you and I spend a lot of time thinking about this stuff. Most people don't. Like, most people, they get the headlines, they talk to their friends, everyone's panicking about the same stuff. And so I think from a political point of view, I think running on the argument of $5 billion is what we're going to create, good thing. Yep. And then they connect it to this enemy. They've created this enemy of the ultra wealthy, which I'm not denying that there are ultra wealthy people that should arguably probably pay a little more tax. I'm not denying that those people exist, but it's like the narrative here is that that's who these taxes are coming out of. Like, but in reality, it's a blanket approach that normal people that are just trying to make a go out of what they've got with their savings are impacted as well. And that's where I struggle with these kind of blanket reforms that come through, because, like, I think through, you know, there's people on our team that have been saving for a deposit for like a year. So they've finally got the capital, they've got the credit, they've got the borrowing capacity, they've been able to buy a property. But now with things like rates are going up, they're struggling to maybe hold that property. And so they might have to consider selling. Now, I know that they're going to grandfather it, but imagine if they had this discount in place and they decided that actually we're going to cut this discount now, and they could potentially have, like, I don't know, $10,000 to $20,000 less gain just because of some policies. And it's like they're already struggling to get into the market and to make ends meet to just try and get ahead. And so it's like these people, that's what I feel the impact on. And maybe it's because of the business that we run that I'm more like connected and in tune with this at an individual level, as opposed to these policies get put in place at like an aggregate level, just looking like, okay, humans in Australia at this level, whereas I see it more from like the individual impact, and that bothers me.
Yes. So what you're effectively saying is you don't think that it's fair that someone who's struggling to get on the ladder, they buy their first property, and just purely because of poor luck and timing, they buy a property after the implementation date, and they are $20,000, $30,000, $50,000 worse off over the long term because they don't benefit from the 50% CGT discount. They're subject to the alternative. Is that what you're saying?
Kind of. It's not. I'm not being specific to the CGT conversation. I'm more generalizing around like government policies that they put in place, like everyday normal people trying to get ahead, and then governments put in these policies that affect everyone, but they have the narrative that like, oh, we're getting it from like the really ultra wealthy, and it's like everyone that we know that has a property is probably questioning these things. Like rates go up, everyone's affected by that. So it's these decisions that are made that affect everyday people. That's more the comment.
Yeah, look, I think you're right. And I think like how they dress up the narrative really, really matters, right? Because, you know, tall poppy syndrome is alive and well in Australia, and even more so in the current day and age. And if the government just said, hey, we want to make more money, so we're going to make some tax changes, and we're going to hit the hip pocket of about 2.2 to 2.5 million everyday Australians by changing tax policies so we can collect $280 billion or $250 billion over the next 10 years. That would be an unpalatable position to take, because everyone would be like, screw you guys. You already take everything from us, you bastards, right? Nobody would want that. But what they want is they want more income. They want to be able to continue to mismanage their budgets without any consequence, right? And so they want more money. And you know what's an easy position to take? Property investors are fat cats. They're getting rich. You can't afford anything. Let's take the money back from the rich people, and we'll make it better for the people who don't have stuff yet. That's a fine position to take, because it's very easy to demonize people. But it's also not true, because most property investors, the vast majority of 75% of property investors only have one property. Sorry, 71% of property investors only have one property, and 90% only have two. Most property investors are everyday Australians, mums and dads, young people trying to get ahead. And so these aren't fat cats sitting in their ivory tower. These aren't, because what often gets quoted in the media is like, oh, there's property investors that own 150 properties or whatever. Look, 0.0000001% of property investors own more than like 20 properties. So yeah, Gina Reinhart owns whatever, several hundred properties. There's a couple of people in Australia that own several hundred properties. Most people don't. There's 2.2 to 2.5 million property investors in Australia. And there's probably less than 50 that have more than 50 properties. The vast majority, like 2 million of them probably, only have 1 to 2 properties.
Yeah.
And so what we're actually saying is these tax policies are going to, so what the government's actually saying is we want more money. So we're going to see where we can take it from in a way that we can demonize one portion of our society against another. We're going to say property investors are rich. We're going to take it from them. Isn't that good for everyone? Yay. Actually, property investors are everyday people. So what are we doing here? And to the points that I've already made, it's not going to change housing affordability, but it's easy to slap that sticker on something. It's like I'm not sure if everyone's noticed the trend of protein in food. Like stuff literally has now got contains protein on the label when it is no different to what it was, right? I bought a bag of oats the other day and it said source of protein. It's like, yeah, sure. But like, it's like trying to pitch.
That's what oats are.
Because it's not protein in it. And it's like, yeah, you haven't done it. This is not protein enriched. You haven't added protein. Yeah, okay. Like oats do have a very small amount of protein in them. Yeah, cool. But don't make out like it's some, there's protein bars. Yeah, there's protein bars out there that I've seen. Can anyone tell that I like to go to the gym? There's protein bars out there that I've seen that literally have no more protein than a Mars bar. But they contain some protein, so they pitch themselves as a protein bar. It's crazy. It's unreal. And so it's very easy to kind of, like there was the whole greenwashing kind of scenario where businesses would talk about how green they went. This is kind of like affordability washing, right? Where it's like, oh, look, this is good for affordability. This is good for affordability. It's like, no, it's not. Like prove it out, do the math, show us how it works. All of that being said, like I don't think that anyone needs to lose their shit over this. I think it's a nothing burger massively. Like I think that in 3 years' time, I think it's almost certain that there's going to be policy reform. I think it's almost certain. I think it's 70 to 75% chance that there's going to be reform. I think that it's almost certainly going to be 33%. I think it's almost certainly going to be grandfathered. And I think almost certainly in 3 to 5 years' time, we won't be even talking about this. Like it'll be a non-issue. And so a really good litmus test of how much you should care about something is, will I care about this decision in 3 to 5 years' time? Because we all have a tendency to stress ourselves out on a regular basis about all kinds of things. Oh my God, I've got this person stress them out. I was like, yeah, are you even going to know them in 5 years' time? Because I think in 3 to 5 years' time, you're just going to get on with it, right? You'll just be moving on.
Yeah. Yeah, I think we've all got a bit of a what is it? Low time preference, high time preference, which is the short-sighted one. Low time preference. I think it's
low.
Anyway, I think when the world is more heightened and there's more going, time preference shortens, so that their ability to see further into the future shrinks, and so everyone gets much more heightened in the short term. And so you're right. I think zooming out and looking at this in 3 to 5 years and thinking through, is this going to have much of an impact? Like, again, the reform might come in, the discount might shrink, but everything else that surrounds this asset class is still supporting that it's going to continue going up and to the right.
It's going one way. It's going one way. Yeah, it's going one way. And it's up and to the right.
Yeah, even with, if you just break down the timing even of like a CGT payment, not financial advice, guys, but like if you go to sell an asset, you declare that as part of a gain in a financial year. So you declare that on the following year's tax return, or that year's tax return, and then you pay that whenever you do your tax return. So it's like, it's quite a delay until you actually have to front that cash.
Yeah. So if you sell a property on the if you sell a property on the 1st of July 2026.
Yeah,
I think we're getting a bit of lag. Yeah. So if you sell a property on the 1st of July 2026, the CGT won't be due until like the 1st or the 30th of May 2028, right? So it's miles away. Blake has popped a good question here in the chat. He said, "Are you not worried that these changes just slowly erode the ability to get ahead?" Yes, absolutely. So Blake, don't misunderstand me, right? So I'm not for these changes. I don't think they should. I'm not sitting here saying I think this is a good thing and everyone should get around it, and this is good for society. I did say earlier that I think it is fairer, and I stand by that statement. I think it is fairer versus someone who's trying to get ahead. I think that's I'm comfortable with that. Do I think that these changes slowly erode the ability? It's okay, Blake. It's all good. I take no offense. I think it's a well placed question though. I do agree that this is going to erode people's ability to get ahead. I think that's a problem. But I think there are lots of things that are eroding people's ability to get ahead. And so your ability to get ahead is still going to be dictated by how well and how intelligently you can allocate capital and time in a rapidly changing environment. Now, what it doesn't do is it doesn't fundamentally change the premise that residential real estate in Australia is the best asset class to own. It doesn't, right? Mathematically, it still stacks up and beats the nearest best by, between 2 and 7 times better, right? So these kind of changes do affect people's ability to get ahead, because if you're particularly, it's easy to anchor on someone who's just starting out. So let's say you've saved and you've finally got a deposit together. Let's say you've managed to save $150,000 and you go and buy a $500,000 house, and then in 12 months it goes up by 20%. So it's gone up by $100,000. Fantastic. And then for whatever reason you need to sell it, right? Or you want to sell it, or whatever the case may be. In the current version of events, you'd pay $23,500 of tax on it, probably, right? Because it'll probably push you into the highest marginal tax rate. In a 33% discount regime, that you would pay $31,000. Sorry, let me get my numbers. I have to be accurate or all. Yeah, you're going to pay $31,500. So necessarily that is don't do public maths. 8%, $8,000 more. It's $8,000 more. Now, in principle, that $8,000 is absolutely could, for that young person, for that person just starting out, I say young person, but you could be any age, just starting out, that's going to be a significant hit. That's $8,000 that they don't have, that they could have had. But there's lots of things you could have had that you don't have. So the thing we need to remember here is it's a reduction of a discount, not an increase of a tax. like I nearly saw, I always used to joke, my dad and I used to joke, like when I'd say like, oh, I nearly did this thing. And he'd be like, oh yeah, I nearly saw a fox, because you can't nearly see something, right? You either did or you didn't. And so this idea that that individual could have had $8,000 more in their skyrocket to go on to the next thing, in one sense, that's real, but in another sense, it's not. Because the fact of the matter is they're still going to have made $68,500 gain or whatever it is, right? Which is still going to be significant. They're still getting ahead by making better choices. Now, the broader issue is, what are we as a society, or what is the government doing as the organizational as part of our society doing to stop the ability to get ahead eroding? Now, I think that this tax is just one part of that? Yes. So I do see that it definitely will erode people's ability to get ahead. But that's also more and more incentive to get going. Because the longer you sit on the sidelines, the longer you wait, the harder it is going to get. It's going to get, I in a previous podcast, it's going to get 6.4% harder. Sorry, no, it's going to get twice as hard every 6.4 years. It's going to get twice as hard to buy a property every 6.4 years. That was 2 years ago that I worked that out. It's going to be worse than that. It's going to be twice as hard. It's going to be more than 2 times harder to get ahead every 6.4 years, or it's going to be 2 times harder to get ahead every probably 5.5 years. So it definitely does change. And this dynamic is going to continue to change. And we talk about this all the time, that the issue is not that you need to invest to make money. The issue is the lifeboat is leaving the shore, right? The lifeboat is leaving the shore. And so that eventually, and there's a lifeline that hangs out the back of that lifeboat, and you need to get on it, because eventually that lifeboat might not be within reach. And we need to try and get as many people on that lifeboat as possible. So that's the idea. In 10 years' time, it's going to be harder to get ahead. In 2 years' time, it's going to be harder to get ahead than it is today. In 5 years' time, it's going to be harder to get ahead than it is going to be in 2 years. In 10 years' time, it's going to be harder to get ahead than it is going to be in 5 years. That trend is one direction, not the boy band. And what we need to do is we need to acknowledge that. We need to acknowledge that and get on board. Did you like that, Gabby?
It's terrible.
Yeah, it's good. We just need to acknowledge that reality. The worst thing that, like, stress and anxiety come when your expectations don't match reality, and you have a choice. You can either change your reality or you can change your expectations. And people might say, well, you can't change reality. You can. You can decide exactly where you want to live, how you want to live, and under what conditions you're willing to live in a certain way. But to a very large extent, it's way easier to change your expectations. So if you stop expecting that life should treat you a certain way, if you stop expecting that you deserve something, that something is owed to you, and if you just look at your environment and the reality of the world around you as it is, not as you wish and want it could and should be, just what it is. Just look at it for what it is, and you say, okay, cool. Am I happy with this? Yes or no? And if you just look at the environment, you say, okay, coll, taxes are changing. Does that change the investment thesis? No. Property is still going to continue to go up because it's not actually dictated by tax policy. I'll have to pay slightly more tax in the future on my gains than I do today. Okay, but fundamentally the maths make sense. So, keep calm and carry on. Shampoo time, yeah, absolutely. So the numbers that I'm quoting here they're oversimplified. So Shampoo Time has put a comment in here: 500K property that went up 100K. There's significant buying costs, etc. 100%, right? So I'm just using generalized numbers here. If you look at the analysis that I put together, it does break it down a little bit differently. It says that if you start with $150,000 of cash and you deploy that, and then it breaks down at roughly a 85% LVR, the deposit plus costs, and then it's the gain on the capital you invested. So if you look at the report, which, as a reminder to everyone, is at tools.dashdot.com.au/CGT analysis. Yep. So if you look at that, that's got a more detailed breakdown. I just find it easy when we're talking on this podcast to simplify the numbers so we can simplify the concepts. So it's not mathematically 100% accurate that if you buy a $500,000 property and you have a $100,000 gain, that, magically, that's all there is. There's selling costs, there's buying costs, there's all that kind of stuff. Absolutely. So I'm not disputing that. I'm just trying to simplify the maths. So hopefully that's okay. Shampoo Time. Don't roast me too much. And also full disclosure, as I mentioned earlier, in the report, I didn't include negative cash flow because what I'm trying to articulate is the concept. right? So not necessarily the mathematical exact reality, but the concept, the premise. And I think that that's important as well, because we can get so bogged down in over indexing on the detail. Now, I'm a big believer in sweating the small stuff as well. That's fine. But we can over index on the detail and we can forget to zoom out enough to see what the real opportunity is. So.
Yep. Agreed. Cool.
Anyway,
Goose, I'm freezing my ass off. I would like to go inside.
Okay.
It's so cold.
Well, I would like to keep Gabby's ass intact. So let us get her inside. Thanks for joining us live once again. Thanks for all of you guys who showed up in the chat, guys and girls. Thank you so much. It's really awesome to see you. Really appreciate it. Lots of really great engagement in the chat there. I wish we had more opportunity to talk to you all and have much more interaction. Maybe we'll try and do something where we can all get together and chat on one of these lives. But thank you so much for showing up. We really appreciate all of you. If you're not watching this live, leave us a comment on the YouTube video. If you're watching it there, if you're anywhere else, make sure you like, subscribe, do all that kind of stuff. The more that you share it, like it, do all that kind of bizzo, subscribe to all that stuff. Helps the algorithms, helps this kind of stuff get out. And the report, tools.dashdot.com.au/CGT analysis is free. So you can access it. We'll put links in all the places, or you can just listen to the words that I said and type it into your URL and get it there. Share it with other people, because it really is a useful way to break down the thinking around this. Again, our whole team we're really grateful to receive this, because it was useful to them, because it's useful to our clients, so it's useful to you. And as a final point as well, if you want to get macro intelligence every single week updated in a way that is not found anywhere else in the country, completely unique, we build a completely unique and valuable system to get you macro insights on a weekly basis called The Signal. If you want to get that every single week, just go to dashdot.com.au/The Signal and you can check it out there. You don't have to subscribe, but you can if you want to get it in your inbox, or you can just go to that website link every single week, check the updates and get it for free, because we want to help you become a more informed, a more intelligent property investor. That is all for today. Thank you so much. You're all the best. Every single one of you. Everyone gets a trophy. I don't like that. And anyway, let's move on. Thank you, guys. See you next time.
Bye.